I'm joined here today by Olivia Thoral, AXA Real Estate, Dan Fasulo of Real Capital Analytics, and Jason Fox of WP Carey. Thank you all so much for joining me, gentlemen.
You're welcome.
Thanks, Zoe.
Institutional investors often say that real estate managers don't think through their exits properly, that they like buying and acquiring assets but are perhaps a little bit too slow to sell. Obviously, as we look out to real estate markets globally, we're witnessing sustained recoveries and perhaps full recoveries in some instances. It'd be great to ask that question, is this a time to sell? Is this a time to be looking and preparing for an exit from the real estate assets? And Dan, I'd like to open up to you if that's okay. Can you tell me where we are in the cycle, given what you're seeing with global capital trends?
Well, RCA tracked over $1 trillion worth of property sales last year. And that basically is almost back to 2007 levels. I mean, these guys will tell you, for any type of core asset globally at this point, there's a massive amount of liquidity, both on the equity and debt side.
Can we say that commercial real estate markets have fully recovered when you look globally?
The globe is a large place, right? And there's been different recoveries geographically by property sector. Certainly Asia is trading at levels that it's never seen before. The pace of investment activity is well above what we recorded even at the last global peak in 2007. The U.S., we saw about $350 billion worth of sales in 2013. It's basically back to 2005 levels, up 20% versus the prior year. Europe is kind of chugging along. Certain countries have seen, more significant recoveries. The UK, for example, even some of the countries on the periphery are starting to come back.
And I do want to dig down later on in our conversation about obviously the US and Europe, but let's dig into kind of some of the exit strategies and some of the liquidity solutions that are obviously out there for the managers. And Olivia, you were a significant seller in 2013. Just summarize your activities.
Okay, that's absolutely correct. I'm part of AXA Real Estate, which is an investment manager, part of the wider AXA Group. We are managing on behalf of real estate assets on behalf of AXA and third-party clients. So we have a number of very active accounts, both insurance companies and third-party institutional investors. So when we look at our activity, we also look at the objectives of our clients, taking into account the markets. And yes, we've been an active seller in 2013. We've been seller because we believe that in a number of markets that was the right time to sell, notably core assets in some of the European countries, in the major cities like Paris. We have sold in those type of core prime properties. We have also started to sell in the course of 2013 in Southern Europe, where there was no liquidity before, but liquidity is back now in Spain, in Italy, and we've been also very successful there.
Can you quantify how much you were actually selling in 2013?
In 2013, we've sold over 3 billion euros of real estate equity investments. So that's a meaningful amount, and that includes really a variety of assets ranging from office to industrial, retail properties. So it's been a very busy year in terms of sales.
And Jason, obviously WP Carey is a significant buyer out in the market, particularly with the stabilised single-tenant properties. Right. Well known for corporate sale leasebacks, but you're also moving into secondary transactions as well, buying from investors and funds. Just describe your activity in 2013 and how it looks for 2014 as well.
I mean, we've been a good source of liquidity for some of the exits that Olivier is talking about. Particularly in Europe for that matter. We've been a big buyer in Europe in 2013. We see that continuing in 2014. I think certainly relative to 2012, these are much bigger years. I mean, we're also a seller in some instances as well. I think there is opportunity to sell in a market like this, and we take advantage of that by pruning our portfolio. We can trade out of marginal net lease assets into higher quality, and I think the spread between pricing or yields on marginal and high quality assets is about as tight as it's been. So we're taking this opportunity to really upgrade our portfolio with some sales. But the focus is going to be on buying. We're a long-term holder of assets. Our investors invest in us because they want durable income, and that's what we're able to provide through these long-term net leases.
How do you view the pricing today?
I mean, it's very competitive. There's a lot of money out there globally, for that matter. Particularly in the U.S. and Asia, as Dan is saying. I mean, the one thing I will say is that asset level prices, yes, these are near the top. They're where pricing was in 2007. But some of the differences, especially for spread investors like us, they're looking to return income over a long period of time. The spread is better now than it was in 2007. Borrowing rates are lower, and you're able to get some stronger equity cash flows for the investors.
And Dan, just give me a sense as to kind of who are some of the biggest sellers out there in the market today?
It's a combination. A lot of the funds that were very active in 05 through 07, the life cycle of those funds is now coming to fruition, and they're selling into a very opportune time in the market where there is excess liquidity. In Europe, obviously, a lot of governments are sitting with large non-performing loan portfolios and a lot of banks. So they've been significant sellers.
Are you also seeing portfolio transactions? I was just wondering, where kind of some of the greatest activity is as well. Are we seeing more individual assets or actually portfolios?
Yeah, we've seen a massive increase in portfolio activity in the United States. And just over the last 6+ months in Europe, we've seen some of the bigger NPLs start to trade.
Yeah, and even on the equity side, we have sold portfolios, for example, in Italy in the later part of 2013, where it would have been totally inconceivable 6 or 9 months before, but now a portfolio sale in a country like Italy is attracting a lot of interest from buyers. And this has been a very competitive and ultimately very profitable exit for our clients.
And what are your expectations as you look forward for portfolio? Can you kind of forecast what 2014 might be like for the appetite for portfolio sales?
Well, part of what drives our transaction volumes is willing sellers, right? And with prices that have come back to arguably 2007 levels for core assets, it is going to bring out some of the discretionary selling, and it should drive increasing portfolio activity, especially because there is more debt available now to make those deals to come to fruition.
And there's a lot of sellers with pent-up demand to sell. As Olivia said, it was an opportunity to sell over the past 3 to 4 years, and we're taking on that opportunity to find assets that weren't on the market. I mean, it would have been great to buy a lot of assets in Europe in 2010, 2011, and 2012, but the sellers weren't there. So we're starting to see that. I think Europe is, the past 18 months has been a very strong market for us. I think, relative to, say, to the U.S., on a comparable transaction, we were probably seeing 100 basis point spread in yield in Europe. I think that's starting to compress, but it's still a good environment for us.
Are you surprised to have seen the amount of demand, obviously, for transactions, this pace of demand and prices to come back as quickly, perhaps, as they have done? Dan, I'll throw that open to you.
That could start a very long conversation. There's been kind of unprecedented government intervention in the markets that's kind of flooded capital in. You don't know what money's gotten to which party, but there has, structurally, there's been a lot of new money in the system, big sovereign wealth money that's filtering in from Europe, from Asia. We've definitely seen the equity funds out there raising capital hand over fist again. And frankly, 24 months ago, there was only a finite amount of bidders for $1 billion portfolio. Now I hear they're getting double-digit bidders on all these NPLs portfolios in Europe.
And what was it like, obviously, in terms of the bidders that you got, obviously, for AXA, but what you're seeing in the market?
Well, it depends, of course, on the type of properties we are selling, but the large funds are out there. They are now in Italy, they are in Spain, they were not there a year ago. We had done very successful acquisitions back in late 2012 in Spain, and there were very, very few, if not any other bidder than us on a major disposal by a regional government. A year later, the situation has, or 18 months later, the situation has dramatically changed. There are many more investors. The the large opportunistic funds have raised a lot of capital, and they are investing massively in Europe as well.
And obviously we're talking about kind of the funds and investors, but I'd love to bring in, Jason, the thoughts, where are the corporates?
With corporates, we think of sale-leasebacks primarily, and I think the sale-leaseback market is still a little bit slow. And the reason for that is there are good sources of alternative capital, and that's really the reason to do a sale-leaseback. A lot of companies are looking for ways to raise capital, and the bond markets are very, very strong right now. And I think companies are looking into that arena to raise money as opposed to sale-leasebacks. Now, as interest rates rise, and I think everyone expects them to, it's just a matter of when, I think we will see more sale-leaseback activity. Sale-leaseback is a way to really lock in your rental rates or your yields over a long period of time, certainly much longer than bond financing can do. So I think we'll see that.
So when they come back into play, what impact will they have on kind of pricing and the demand that's there at the moment?
I think that the markets can absorb the increase sale-leaseback activity. I mean, what we are seeing now in terms of corporates, and we've seen more of this over the past 18 months, are build-to-suits. And that's really a function of a growing economy, increased production and investment in companies. And so that's been a more active part of the corporate market for us, our build-to-suits, and expansions for that matter. I mean, we have a big portfolio, and a meaningful part of our new investments are with our existing tenants at our existing assets, adding square footage to distribution spaces or warehouses, or doing build-to-suits on new office buildings.
So I'm going to put you on the spot. Very generalistic, but is this a time to sell, Olivier?
We are buying and selling all the time. We are managing over 45 billion euros, so in excess of $60 billion of real estate, and we have over 30 active accounts or funds. So we are buying, we are selling, we are having views and convictions on the market. So we believe that there are certain assets that we can buy now, there are certain assets that should be sold, and we are trying to deliver those plans in the most effective manner, in the best interest of our various accounts, various clients. So as I said earlier, I think it's time to sell core properties, fully leased properties, given the level of pricing. For example, a market like France, we see more downside risk than upside on the leasing market. If certain buyers are ready to pay such a premium for certain properties, we can consider a sale. We have, for example, also unsolicited offers on certain prime properties. It's a question of price and return. There is the question of how you reuse the funds.
And Dan, obviously you were slightly nodding there in terms of kind of obviously the core market particularly. Is this a time that you would sell given pricing and where the market is today?
In my mind, right now we're seeing an extraordinary pricing achieved for core assets with long-term income in place. And I'd probably be an active seller of those assets if I had good opportunities to reallocate those monies to more strategic, better yielding opportunities.
Because that's obviously the question, isn't it, Jason, what you reinvest that capital
That's the big question,
into.
right? And our investors are looking for us to deliver them long-term income, and that's the problem. They don't want to take their principal back, because then what are they going to do with that? They're looking for us to put that to work smartly. And we look at the globe as the opportunity, and different markets rise and fall, and we're trying to buy in those weaker markets. But I agree with Olivier. I mean, a lot of these core markets, they seem overpriced. We look at these transactions, we scratch our heads sometimes when we see the prices at which a lot of these assets trade. So we're not active in those markets. We're looking at more secondary, and we are finding opportunities. We are a seller as well, where we're taking advantage of the capital that's in place, but we'll be a net buyer this year.